Okay, so let's quickly get onto it. Tonight, we are going to be looking at a fresh standard, which is IS 36 on impairment of assets. The last one we finished was financial instruments. And tonight, we'll be moving on to IS 36. And what we have left, I can easily picture what we have left in this class, because from what I can see, our Saturday classes, our Sunday classes, today inclusive, is just 6 classes to go. 6 classes to go, 2 in March, 4 in April. And our Thursdays classes, the plan we had, it was disrupted. But it's not going to be disrupted anymore, because it will continue at least for the next 3 or 4 classes too, for the Thursday. So after all of that, we'll be finishing up the syllabus at record time. So our usual Sunday classes tonight, as soon as I'm done with IS 36 tonight, next week, we're going to be picking up IFRS 16 on leases. We'll try and see if we can finish it in a class, but it's not a topic that is guaranteed to be finished in a class. It's a little wide, but we'll see. It will be nice if we can finish it at a sitting. It will help us, because that means in April, we can easily start ratio analysis. And ratio analysis is something that comes out every diet. So we're going to use 2 weeks for that. 1 week, we used to learn the principles, the ratios, analysis, and all of that. The second week, we then solve past questions. If you can solve at least 4 or 5 questions, that'll be very good for you. That's 2 weeks in April gone. The remaining 2 weeks in April, we would then, all these standards I've been teaching you, since your question 1, the compulsory part is always published financial statements. So we will use the remaining 2 weeks in April to practice that. Again, if you can do at least four questions on published, or at best 5, but considering the limitation of time, if you can do 4 or 5, that would be very good for us. And at that point, our Thursdays classes also would have also yielded some positive results for us. And in between, I'll continue to send you a practice assignment, classwork for you to practice. And if you are practicing all these assignments and reading, revising what we have taught you, you would find yourself in a good position come May. Okay, that's the plan for the remaining 6 weeks left for this diet. So tonight, we're looking at IS 36 on impairment of assets. So the first thing I need to mention around this standard is first impairment. See, this impairment is, in terms of accounting treatment, is very similar to evaluation deficit. Very similar to it. In fact, it's the same accounting treatment. Impairment, the same. You will see. So it's the same accounting treatment with evaluation deficit, but in meaning, they are not the same, because evaluation deficit is like fluctuation in values that went against you. You're looking at the value of an asset, but it was unfavorable to you. Your value went down. That's why you're having an evaluation deficit. Impairment is not about fluctuation in value. Impairment is more of a permanent loss of value, that for you to recover from it requires a lot of hard work, requires a lot of tenacity, it requires a lot. That when we say in accounting, anywhere in accounting, when you see impairment, is a serious loss. Is something more permanent, something more damaging. When we say an asset is impaired, it's strong. But in terms of accounting treatment, it's the same as evaluation deficit, the same. You will see. Then now the assets here, Majorly, the focus of IS 36 is majorly around non-current assets. Speaking of specifically IS 36, IS 16 on PPE, and also IS 38 on intangible assets. So the assets here are majorly PPE and intangible assets. Substantially, those are the assets that we want to impair. Okay, so that's the first thing I needed to mention. The second thing that I really need you to hold all through this class is the objective of this standard. This is very important here. When it comes to IS 36, you really need to stay close to the objective. And what's the objective of this standard? What does this standard wants to achieve? See, the first thing it wants to achieve is, one, is to ensure that assets are carried at no more than their recoverable amounts. See, this recoverable amount, I can, for now, I can easily call it realistic amount or realistic value. So the first objective is that we want to ensure that assets, whether your PP, whether your intangible assets, are carried at no more than, permit me to call this recoverable amount, realistic value. You should never, IS 36 is saying, no, that should never happen. IS 36 is there to ensure that it never happens, that the assets you have in your books, your PPE or your intangible assets is now carried at more than its realistic value. We don't want that. And IS 36 will teach you how to ensure that never happens. And the second objective is that you then have to describe an asset as impaired when its carrying amount exceeds the amount to be recovered through use or sale, meaning that you are going to describe that asset as impaired if it happens that you are now carrying that asset at more than its realistic value. That's what the second objective is saying. If it happens that you are carrying an asset at more than its realistic value, then you will seriously need to describe that asset as impaired. Impaired. That is the core objective of this standard. That is what this standard wants to achieve. Those are the two core objectives. One, to ensure that assets are carried at no more than their realistic value. It should never be more than their realistic value. We don't want you overstating your asset. Do not overstate it. And if that should happen, describe the asset immediately as impaired. If you find yourself in a position when you're carrying your asset at more than their realistic value, you should describe that asset as impaired. He has some other objectives which I would also touch on as we move along in this class. See, from this objective, there are three main terms that need to be addressed quickly. Number one is impairment loss. It says describe an asset as impaired. What does it mean to describe? What does impaired means? Number two, I've been saying carried in your books, which is what you know as carrying amount of an asset. What is carrying amount of an asset? I believe by now, every one of you sitting in this class should know that. And thirdly, is recoverable amount, what I've been calling the realistic value of an asset. Recoverable amount. So let's quickly attend to that. So the first one, which is impairment loss. Impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. The amount by which the carrying amount of an asset exceeds its recoverable amount. So, remember the objective. Carrying amount should not be more than. If it happens like that, then, the difference the excess by which that carrying amount is higher or exceeds that recoverable amount, that's impairment loss. Is impairment loss, is a loss because it means you're overvaluing your asset. So the amount by which carrying amount exceeds recoverable amount is impairment loss. Then two things here. First is carrying amount. Is the amount at which asset is recognized after deducting accumulated depreciation or amortization and accumulated impairment losses. The amount by which an asset is recognized after deducting any accumulated depreciation and amortization and accumulated impairment losses. You all know that. Recoverable amount. This is the higher of fair value minus cost of disposal and value in use. Remember that recoverable amount, I said, is the realistic value of an asset. So here now we are saying it is the higher between fair value minus cost to sell or cost of disposal and value in use, the higher of the two. Okay, before I make any comments more on these recoverable amounts, then we need to know what fair value is. Fair value is the price you would receive when you sell an asset. So fair value of an asset is basically the selling price of that asset. How much are you going to receive when you sell the asset? Value in use is the present value of future cash flows from using an asset, including its eventual disposal. You see, why fair value is selling price, the amount you get when you sell an asset immediately now. Value in use is if you decide not to sell and you continue to use this asset, how much are you going to make till the end of the life of that asset, including how much you would sell the asset eventually at the end of its life. Of course, when you're talking about how much you would make in the future, for us to make sense of that relative to value today, we need to discount it to present value. So when you discount those future cash flows to present value, that's value in use. So value in use is the present value of future cash flows from using an asset. Present value of future cash flows. So if I continue to use this asset, how much money will I make for the next remaining life of these assets? You would estimate that. Nobody knows that for sure. Probably be an estimate. Then those future cash flows, you discount everything to present value. Add them together and get value in use. Okay. So therefore, recoverable amount is the higher of that two. Is the higher of how much you get from selling and how much you get from continuing to use an asset to its end of its life. The higher of that, we believe that that's the realistic value of that asset. We believe that the book value should never be higher than this amount. It should never. That's what IS 36 is saying. The realistic value of an asset is the higher between how much you will get from selling and how much you will get from using. The higher of the two is the realistic value. So whatever you have in your book should never be higher than that. Okay, now I've laid the foundation. The principle here is straightforward. It's so straightforward. Never allow your book value to be higher than its realistic value, which we call recoverable amount. And that recoverable amount is the higher between how much you can sell an asset, which you call fair value minus cost to sell, and how much you can get from continuing to use the asset, which is value in use. Now, if that is the underlying principle in IS 36.
Sorry, Mr. Can you say that again?
I said the underlying principle is that ensure that your book value is never higher than its realistic value, which is the recoverable amount. And the recoverable amount is the higher between how much you will get from selling an asset and how much you will get from continuing to use the asset. We believe the higher of the two is the recoverable amount, is the realistic value of an asset. So your book value should never be higher than that. We need to ensure that never happens. That is the core principle in IAS 36. It should never happen. Your book value, your carrying amount should never be higher than its recoverable amount. That is the underlying principle. As simple as that sounds, practically, it's not simple. And you need to know how to do it. That's why you're writing ICAN. So how do we do this? So the first question we need to answer is, at what point would you even know that your carrying amount is higher than its recoverable amount? At what point are you going to know that you are most likely carrying your asset at more than its realistic value? You might never know. You might never know. That's the reality. Because this recoverable amount is not something that is readily available to you. Fair value is not something that is readily available to you. It's something you need to consciously go out to get that value, especially an asset that you're already using. You need to consciously go out, and a lot of people really care less about that. Why do I want to care about how much I would receive when I sell the asset? I don't want to sell it. So nobody cares about how much I would receive when I sell. So why would I want to care about that? Or value in use. Why would I want to be doing present value? So these figures are not readily available to you. So and I statistics is saying ensure that your book value is not more than them. But they are not available. How would you know? Okay, then that takes us to indicators of impairment. Identifying a potentially impaired asset. There are external indicators and there are internal indicators. These are the signs you will see in the functioning of an asset from your operating environment that would indicate you and alarm you and tell you that you're probably overvaluing your asset, that you're probably carrying your asset at more than its realistic value. These are the signs you will see. This part of this standard is a darling to ICAN exams. Anytime they want to ask you a question on IAS 36, be sure that they will ask you this because it is the starting point. It's very germane. There's nobody that wants to impair an asset that will not have seen one of these signs. So number one, when there is a fall in the market value of the asset, when the market value of that asset falls, it is a sign. I mean, if you are lucky to be able to take note of that, there is a potential impairment. You're potentially carrying your asset at more than its realistic value, or probably where there is a change in technology, markets, legal, or economic environment in which the asset is employed. Technology can render an asset obsolete. You are using an asset that nobody is using again in your industry. You are probably overvaluing your asset, that asset in your books because it's obsolete. Or the markets are not demanding the product that you are producing from that asset anymore. People have moved forward. Or there is a legal framework in your country that discourages the use of that asset. I mean, or the economy is moving towards another asset entirely. A change in technology, market, legal, and economic environment can indicate that there's a potential impairment. It can indicate that the book value of the asset is more than its realistic value. Yes. Another one is when there is an increase in market interest rates or market rate on return that is used to calculate value in use. Remember, value in use is the present value of future cash flows. It's the present value of future cash flows. That's how you get value in use. And to do present value, you will definitely use a discount rate, which is usually a market interest rate. And for those of you that are doing performance management, you might know that the higher the discount rate, the lower the NPV. The NPV here is synonymous to net the value in use. When your discount rate is high, your value in use becomes lower. That is why this is an indicator of impairment. Now in our country, within few months, we had a significant increase in NPL by over 700 basis points. That means majorly market interest rates in Nigeria has increased. That is a trigger alarm for impairment possibility. It is a possibility that we might be overvaluing our assets in our books. We might be carrying it at more than its realistic value because there's an increase in market interest rate. Or if your book net assets, your balance sheet value, when it becomes higher than market capitalization, this is typical for companies that are listed on a public market, right? And they have a market capitalization. It now happens that your balance sheet value, your net assets, is higher than your market capitalization. And market capitalization is the number of shares minus your share price in that market. Your book value, your balance sheet size is not more than that. It's an indicator of impairment. It's an indicator that your asset is probably overvalued. These are external that the company really does not have control over because they are market-based. The ones that are internal are when there is a physical damage on the assets. When an asset is physically damaged, whether an accident or through whatever means, is damaged. Or when there is an adverse change in the use in which the asset is put, or asset economic performance. An asset that was doing 10,000 units per day before, now can only run for 5,000 units. Can only do 5,000. The possibility that whatever book value you have in your balance sheet is probably overvalued. Or there's a decline in useful life of that asset. The expected useful life has declined. You see, all of these, they are indicators of that you're overvaluing your assets. And all of these items, they are major events, like when an asset is damaged, when an asset is not performing so well, or when there's a decline in useful life. You see, these indicators are so strong that it supports my initial hypothesis that impairment is a permanent loss. It is, useful life has declined, performance has declined, the asset has damaged. That is different from evaluation deficits, far different from it. Or market value has declined. Technology went against you. These are powerful events that before you can recover from them, it only takes luck. So impairment is a permanent loss. You see, a simple word for looking for these indicators is known as impairment review. Looking out for these indicators is known as impairment review. So when you are looking for indicators of impairment, we say you are doing impairment review. So take note of that word. You might see it in the exam. So you will know that impairment review is the start of the impairment process. It really starts from impairment review, looking out for what will prompt you to kickstart the impairment process. It all starts from impairment review. Now, see, all this impairment review is, if you then see any of these signs, then you move to the next stage, which is impairment test, testing the asset for impairment. Impairment tests. And impairment tests involves two stages. There are two steps in impairment tests. Number one, calculating or determining recoverable amount. You need to determine recoverable amount. And remember what recoverable amount is. The area between value in use and fair value minus cost to sell. That's recoverable amount. That's the first thing you do in it. So it is an impairment test that you now consciously go all out to get, okay, I need to get the realistic value of these assets. What is it? That's when you then go all out and derive it. Impairment test. So you derive the recoverable amount. You sit down, you go and get what's the selling price of these assets. You apply IFRS 13, which is beyond the scope of this syllabus anyways. You'd use that to get the price you will receive to sell, the fair value. You get that on one side. You also calculate the value in use, where you sit down and say, okay, this asset, how many years does it have left? Okay, he has 5 years left. How much am I going to make for the next 5 years? You estimate that. You then take a discount rate. That what's the MPR today? Okay, let me add 3% premium. I take that as my market rate. I use that to discount that future cash flows to present value. I get my value in use. I pick the higher of the two between the value in use and net realizable value. I pick the higher of the two. That becomes my recoverable amount. I keep that aside. When I get my recoverable amount, I just compare that to my carrying amount. Your carrying amount is in your book, so that is always readily available to you. You compare it. And you see, that process of comparison will then give you impairment loss, because you will then find out that your carrying amount is higher. That's impairment loss. That's impairment loss. So, really, that's everything around IAS 36. It's no more than that. I mean, I assure you. The only thing that is left is just applying this to several scenarios. And there are like 3 or 4 scenarios that I just need to give to you. Then I'll be done for today's class. Then we'll solve a good question. Then we would, that's everything. Okay, so let's go through those several things you need to note. So please, every other thing that is coming out from my mouth now, I need you to pay maximum attention to it. Maximum attention. So the first thing is this. You see, you have already learned the objective. I defined some terms to you. I talked about impairment review, then impairment tests, right? So the very first thing I need you to know is that there are 2 sets of assets that you test them for impairment every year, annually. In the sense that you don't even need to look for, you don't need to carry out impairment review on those assets. You don't need to look out for indicators of impairment like you do for other assets before you go to the level of testing. For these 2 sets of assets I'm talking about, you test them for impairment every year, annually. And what are these 2 sets of assets? Number 1 is an intangible asset with an indefinite useful life. Number 2 is goodwill acquired in a business combination. Number 1 is an intangible asset with an indefinite useful life. Goodwill acquired in a business combination. Mr. Abiodun has taught you group account. Every one of you here knows that the only goodwill that is recognized in the account is the goodwill recognized in the consolidated account, because that is the one that can be measured reliably. You see, that goodwill needs to be tested for impairment annually. Secondly, an intangible asset with an indefinite useful life is an intangible asset that you do not amortize, meaning the value remains the value year in, year out. The only way we need to test the sanity of that value is by testing it for impairment every year, just to ensure that we are not carrying it at more than its realistic value. These are the two assets that you test for impairment annually. That's the first thing I need you to note after the core principle I've mentioned. The second thing that you seriously need to address before I solve these questions is, let me address this. So when you have impairment loss, what's the double entry for it? You simply debit P&L, you credit the assets. Okay, that's for an asset that is carried at cost model. Simply debit the assets. You debit P&L and credit the assets. But for an asset that is held or measured at evaluation model, okay, that kind of assets, you will not just debit P&L, you have to debit OCI, you debit P&L with the impairment loss, and you credit the assets. Okay, so why are you debiting OCI? It's just for example now, let's say for a revalued asset now, it's possibly that in previous year, let's say there is a revaluation surplus. There might have been a revaluation surplus of, let's say, 10,000. So in this current year now, since we are talking of impairment, let's say there is now an impairment loss, let's say 15,000. So when you want to account for this loss now, you don't just take this loss straight to P&L because there was a previous surplus. So if there is a previous surplus, you need to net off that surplus through OCI. You need to net it off first. That's why I'm debiting OCI. Then, with, of course, to be with 10,000 to net off that surplus. Then the excess, the remaining loss of 5,000, that goes to P&L. Then you credit the asset to 15,000. If you had been in this class from the very beginning, you will know that this is exactly the treatment of evaluation deficits. But for an asset at cost model, that one doesn't require any, there won't have been any previous surplus anyway. So impairment loss you have, you simply debit P&L and you simply credit the assets. Okay. That's the journal entry for impairment loss. Okay, I can see a hand raised. Can you go ahead with your question, please?
Thank you, sir. Good evening, sir. Just want to ask, sir, I know in PP, you made us to understand that land is one of the assets that has an indefinite life. So that is why we don't depreciate it. So now you mentioned that there are intangible assets with an indefinite useful life. Can you just give us an example of such assets?
Okay. I will have told you that I'm surprised you're asking that because we did IS38 together here in this class. And I mentioned to you, this thing I've mentioned it before. This is not the first time you're hearing this. Under IS38, I told you that there are some assets that have an intangible asset that have an indefinite useful life. And these assets, you do not amortize them. What you do to them is to test them for impairment annually. And I've told you that most intangible assets have an indefinite useful life. A lot of them. One, when you have a website, it has an indefinite website. Most of them does not have a definite. It's just there. It's there. Probably maybe your database is there. Maybe your app is there. Maybe you have a software is there. Most intangible asset has an indefinite useful life. In this current technological space, they don't have a definite useful life. So then you can then start be looking at the structures, the basis and all of that. Then to see maybe there's an agreement that can restrict his life. But for the most part, it's technological assets, and most of them have an indefinite useful life. Okay. Now, having mentioned that, then the next thing is this. There's something we call cash generating units. Cash generating unit. And the way IS 36 define cash generating unit, it says is the smallest identifiable group of assets that generate cash inflows that are largely independent of cash inflows from other assets or group of assets. That's how they define cash generating unit. The smallest identifiable group of assets that generate cash inflows that are largely independent of cash inflows from other assets or group of assets. Okay. So how does this relate to what we are talking about here? Why is this standard talking about cash generating unit? Okay, let's see if we can relate it. So the thing is this. Are we supposed to impair all PPE and all intangible assets? Are we supposed to impair them? The answer is yes. You must. If you want to follow this standard, this is you must impair them. So you need to always test them for impairment. If that core objective of this standard is breached, when your carrying amount is higher than its realistic value or its recoverable amount, you need to impair all PPE and intangible assets. Another key question is this. Can we actually do that? Is it possible to do that for all set of PPE and all set of intangible assets? Is it possible? The answer is no, it's not possible. Let me give you an example. So if you have furniture and fittings that you use to sit down, your windows, your fittings generally, or you have computer equipment in your office, or you have air condition or elevator. You see, the common thing around all these assets I'm mentioning is they are assets that you don't make money directly from them. They are assets that you cannot say this is how much I've made on this asset this month. They are only there for administrative purposes. Now, this set of assets it then becomes impossible for us to get their recoverable amount. I mean, specifically, their value in use. Remember, value in use is the present value of future cash flows. Value in use, to get value in use, it's assumed that you can estimate future cash inflows. It's assumed that that asset makes money. So when you have this set of assets that do not make money, that means you cannot estimate future cash flow on them. That also then means that you cannot get their value in use, which also then means that you cannot get their recoverable amount, which ultimately means that you will never be able to get whether they are impaired or not. But this standard is saying that we must impair them. Then how do we do that? We do that through cash generating units. So what we mean by cash generating unit in simple term is that all these assets that are not making money on their own, is it possible that when we put them together, when we accumulate similar assets, that together we can say this is how much they make? Can we do that? Can we identify those assets? The standard says you must be able to identify it. So instead of looking at furniture and fittings, elevator, air condition, when you know they don't make money, why don't you just look at the whole building itself? If you can easily know that, okay, this building, this is how much we make from this building. Or a more practical example would be a supermarket, for example. Now, you run a supermarket. A supermarket, inside it, there will be a refrigerator. Inside it, there will be air condition. There will be a lot of fittings, furnitures. There will be a lot of assets inside. But the reality is that these assets, they don't make money. What makes money are the inventory you sell. So when you want to get impairment loss on those assets for such business, you just see the supermarket has a CGU as a unit, because from the supermarket, you can say, this is how much we make today. This is how much we would make tomorrow. This is how much we would make next year. It's easy because you know how much you make from the supermarket. That is the idea of CGU. So CGU, if you are operating a business where individually your asset does not make money, you cumulate all your assets together, you will see the entire business as a CGU. So that CGU, the valuation will just be the valuation or the book values of all your assets. All your assets. Then when you put all your assets together, then you are seeing them as, okay, this is my business. How much am I making from this business? Then it is how much you are making from that business. Then you'll be able to then estimate future cash flows. Then you would be able to get value in use. And when you can get value in use, as students, you can get impairment loss. You can get, because net realizable value is not the problem. You can always know how much you can sell them. That one is not the issue. And I can tell you confidently that CGU, its main purpose in life is to help us calculate value in use, is to help us derive value in use. As soon as it does that, it ends its purpose. That is all it does for us. And that is why they defined it as the smallest identifiable group of assets that generate cash inflows, largely independent of other assets. So look at something. Let me give you a practical scenario. So if you have assets like, let's say you have land and building, and the carrying amount is, let's say, 20. You have elevator, let's say this 15. You have air condition, let's say this 7. Okay, let's say these are all the assets you have in your business. So this becomes your CGU. Becomes your CGU, provided they give you the value in use. So if I add this carrying, let's say these are the carrying amounts. Let's say this carrying amount. If I add these three together, what does it give? 27. That's around 42. Yeah. Yeah, that's 42. So let's say they now give us, the examiner will actually give you value in use. The exam. Let's say they told us that the value in use is let's say they give us 37 as value in use. So that being the case, that means this asset is impaired because the book value of this business is higher than value in use. So that means there is an impairment loss of how much? Of 5. I mean, that is that simple? Promise you, is that simple? So now, having derived that, this 5 million, how do we then put this in our books? Yes, debit P&L, you're supposed to credit assets. Which assets? There are 3 assets. There are 3 assets here. So how do we do it? How do we do it? Is there anybody that can logically help us? How do we effect this 5 naira on each of these assets? Anybody? Anybody here?
Prorate, sir.
Prorate. Okay. What do you mean by that? Let's start with land and building. What do you mean by prorate?
We add 20 plus 15 plus 7. That gives us 42. So
Okay.
20 over times 5, 15 over 42 times 5, 7 over 42 times 5.
That's the logical thing to do. That's absolutely correct. That's what you do. So I hope you have calculators because I will really need these figures. What's 20 over 42 times 5?
That's 2.38.
Let's say 2.4. How about this one?
17, Abi. 15
Yeah,
over 40.
15 over 42 times 5.
That's 1.78.
Let's say 1.8. How about
And
this?
this 7 over 42 times 5. That is 0.83.
Let's say 0.8. Okay. So that's how you share the impairment in such a way that the new carrying amount would then be 20 minus 2.4. That's around 17.6. 15 minus 1.8. That's 13.2. 7 minus 0.8. That's 6.2. That's our new carrying amount. And that's it for CG, even though that's not all. But that's the ideology. If I give you the further details. Any questions? Any questions? Okay. Okay, so I want to ask you a question then. Let's assume for land and building, let's assume we were given net realizable value because the net realizable value wasn't actually the problem right from the beginning. It was really the value in use that we could not get. So let's assume they give us the net realizable value of the building to be 18 in the question. Let's say this is available for only land and building. And here now we are using 17.6. So which one do you think is appropriate to use between the 17.6 and 18 for the new recoverable amount or the new carrying amount of these assets?
If we use 18, it will be more than 5. The impairment loss will be more than 5.
Get to that, but at least let's even know which one is the right one to use first.
I think we should eat 17.6. I think.
Okay, that it should still be the 17.6. Okay. It should be the 18. And the reason is still the core principle I taught you, that impairment loss is we want to write down the value of an asset, the book value, to its recoverable amount. What this new carrying amount should show, it should show the recoverable amount of that asset. And recoverable amount is the IR between the value in use. This 17.6 is just value in use. Is if you add these three together, 17.6, 13.2, 6.2, it will simply give you this 37. ultimately. So this 17.6 is value in use. And they gave us net realizable value as 18. So you just simply pick the higher of the two. So it should be 18, not this one. So it's not this one that would fly. Rather,
Sir,
yes.
it means that if the net realizable value is given, then we will not need to calculate this 17.6. Then,
You're absolutely correct, though. So that means all this one that we did, this allocation will not be necessary
for that land and building only.
for that land and building only.
Thank
You're absolutely correct. Because if the examiner consciously gives you net realizable value, be sure that they know that it will be higher than whatever you get here. They know. So this allocation will not be necessary. So all you just need to do, anytime you have a CGU like this, that's they group those assets together, they give you value in use for all of them. And they now say, one of the assets has a net realizable value of this. Just write down this carrying amount to that net realizable value. Make the new carrying amount be that net realizable value in such a way that what would then be the impairment now? For this land and building now, what would be the impairment loss?
And that will be 20 minus
17.6 Bawo again. 20 minus 18, 2.
20 minus 18, Jerry, sorry.
20 minus 18, 2. So that means automatically out of this impairment loss of 5, land and building 2. So the remaining 3, you can then apportion it between the remaining 2 assets in such a way that elevator will now get 15 over 22 times 3, while AC will get 15 over 22 times 3. You know the way I got this 22? 15 plus 7. Since I'm sharing it between these two only, elevator and AC. So I'll operate it 15 over the addition of these two, which is 22, times the remaining depreciation, impairment. Then this one 7 over the addition of the 2 times the remaining impairment loss. So whatever you get is what you now put here as impairment. Everything will balance out to be 5. So that's how extreme it can get. And ultimately, what I'm saying here is this: if the examiner simply gives you the net realizable value of one of those assets, just make that a new carrying amount. Then whatever it is that is the difference between these two becomes the impairment loss. And it's possible that they give you the net realizable value to be 20. They give you the net realizable value to be 20. That means impairment to be 0. That means it's 0. This class is too quiet. It's never this quiet. I usually have a lot of you talking before. Okay, Bexinda is not here. Those are the people that used to talk. That's Latif. What's his name? Oliver. And sometimes Joseph too, and Ahmed. I'm used to hearing those voices. I'm used to not hearing the other people, so I'm not surprised. So finally, on CGU, Finally, on CGU is yes, the whole idea of CGU has been communicated very clearly, where you need to put those assets together to get how much they make. And ultimately, you can easily get your impairment loss. Yes, that's the principle. But you need to also note that when you have impairment loss from a CGU, we believe that there are two key assets that will have been the key cause or the resulting factor or what caused that impairment loss. We believe there are two critical assets that will have caused it, that will have led to that impairment loss. And we believe that when you are allocating that impairment loss to assets in the CGU, you need to prioritize those set of assets. So there are two key assets that usually cause impairment loss. And the first one is if within that CGU, there is a physically damaged asset. If within the CGU, there is a physically damaged asset, we believe that that is a major cause of that CGU. Believe that is a major cause of that impairment loss. I mean, the major cause of that impairment loss if you have a physically damaged asset. In such a way that if the examiner within this question that I have now, they tell us that the elevator is damaged and the value is 15. You see, this 5 that we have here, we're going to allocate the whole of it to this elevator. The whole of it, because we believe that's why we are having impairment loss in the business, because the elevator is damaged. That's why we are losing money. So that's one. Number two, if you still have extra impairment loss, for example, now, if this impairment loss was, let's say, 20, and they told us the elevator is damaged, and the elevator is only 15, so you would give the elevator the whole of its 15 to write it off from our books because it's damaged. So we'll still have 5 remaining. Then the next one we believe will have caused that impairment loss is goodwill. We believe it's goodwill. That's the next one you allocate to. We believe that is what will have caused it. So if you have goodwill in a business, when goodwill is involved, we believe and that business, there's an impairment loss on it, is goodwill. Is goodwill that will have caused it. Because impairment loss in a business means the business has started losing money. And if you look at it very well, is either customers are not satisfied with your product anymore, and people have started dragging you on social media, and I mean, you're losing goodwill. That's why you're losing money. That's why your business is impairing. So we believe it's goodwill. So yes, we prioritize physically damaged assets first, then goodwill, then goodwill. Those are the two assets you need to always prioritize. Always, always. Physically damaged assets first, then goodwill. Then any other assets on a pro rata basis. Any other assets on a prop, then whatever impairment loss that is remaining, you share it among the other assets. Okay. So that is the entire principle. So what is left now is just for us to solve a good question, and we can sign out. Before I solve this question, I need to tell you that when you have current assets within a CGU, don't allocate impairment loss to it unless the examiner specifically tells you to do so. When you have current, please listen to this. So when you have current assets in a CGU, don't allocate impairment loss to it unless the examiner specifically tells you that that current asset is impaired. And the reason is that, when I was doing my introduction, I told you the assets here are majorly, PPE and intangible assets. So current asset does not even fall here. Not only that, when you then go inside current assets, you find items like cash, your current tax asset if possible, and some other items that don't impair. The only one that impair among them will probably be trade receivables, and that is even covered in IFRS 9. But that does not mean it's exempted here, right? Doesn't mean it's exempted, but we don't know, which is why I'm telling you that when they give you current asset as part of the CGU, don't allocate impairment loss to it. Don't, unless the examiner tells you that this one also has been impaired, then you know that okay, let's allocate to it. Otherwise, don't. Any questions? Any questions?
Hello, sir.
Ahmed.
Yeah. Can you shed more light on the impairment relating to that current asset?
I said that when you have current assets in a CGU, don't allocate impairment loss to it. Don't allocate impairment loss to it. Like in this question now, current assets is there. You see that we didn't allocate any impairment loss to it. And the reason is that IS 36 is not covering current assets. It really majors on PP and intangible assets. And additionally, current asset comprises cash, current tax assets, and majorly most of these assets are not in inventories, trade receivables, right? So we don't know which one. It's not all of them that usually impair. So when you have current assets, don't allocate. Here, when you look at this question, this is a very simple question, which I would just ask you to look at. They didn't allocate any impairment loss to these current assets. They only gave to goodwill first, and to the building and plants, they shared it based on the way I've explained to you before, on a pro rata basis. Shared it on a pro rata basis to them. Nothing to current assets. Don't. The only instance where you would ever do that is where the examiner tells you that current assets is also impaired. That's the only instance where you consider it. Okay. Now, is it possible for impairment to reverse? Yes, it's actually possible for impairment to reverse, even though it is unlikely. It's an unlikely event. But I mean, not to say that it's impossible. Yeah, if it happens, then you can reverse it. So, and when you are reversing an impairment loss, somebody is asking what's the meaning of CGU? Cash generating units. Cash generating unit. That's what I took a lot of time to explain. Maybe I didn't mention the full meaning. It's actually cash generating unit. Okay, so very quickly, I want to make mention of this reversal. Yes, it's possible to reverse. And the double entry for this reversal, ordinarily when there's an impairment loss, you debit P&L, you credit assets. When it reverses, it's just the opposite of it. You simply credit
Pure.
and you debit assets. It's just the opposite of it. But the thing is that before you can do this, we expect some conditions to have happened. We expect some things to have happened. Number one, we expect that we want to be seeing some positive indicators of impairment. Positive indicators around that asset. See, those indicators are mentioned. There's when there is physical damage. It means that you must have upgraded the assets. I mean, so well. Or where there is decline in economic performance, it means that the economic performance of the asset must have improved. Or the useful life has even increased. Or technology is now in your favor, something like that. So there has to be positive indicators. And also, we need to see that, okay, now you have a revaluation. There's a revaluation surplus happening around that asset. You need to see that before you can talk of reversal. And also is that the new carrying amount of the assets, the new carrying amount must not be higher than the original carrying amount before impairment. So the new carrying amount of the asset, after the revaluation surplus, the new recoverable amount now, it must never be higher. In fact, let me put never. Must never be higher than the original carrying amount before impairment. Do you understand this third point? I think that's the only one that does not seem straightforward. This third point. The new carrying amount must never be higher than the original carrying amount before impairment. What this means is this. Let's say in year one, before impairment, the original carrying amount was, let's say, 100 in year one. Then you determine let's say you add the recoverable amount, let's say 70. Which means that in your books, you should recognize an impairment loss of how much? 30.
30 years.
Yeah. So let's now say in year two. What will your carrying amount be in year two? What will be your carrying amount in year two?
Depreciation. Depends on the depreciation charge.
Sorry? I didn't get you.
It depends on the depreciation charge on the second year.
Okay, let's assume there's no depreciation.
Okay. So means 70.
Thank you.
70.
70. Yeah, thank you. 70, yes. Because since we already wrote down the asset from 100 to 70, that means the book value is now 70. So in year two, we open it up with 70. Good. So let's now see they gave us recoverable amounts. Let's say 110. Let's say 110. Which means that we are having a revaluation surplus of how much? 40. So in this case now, what will be the reversal of impairment loss?
It shouldn't be more than 30. It shouldn't be more than 30.
Thank you very much. Shouldn't be more than 30. Why?
You have said it before now, before the exam.
Which is, say it. I want you to say it.
You should not carry it more than the, what is it? This term, sha. So we just can move forward.
Okay. So this recoverable amount now, it cannot be higher than this one, this 100, the original carrying amount before impairment. So as soon as we saw that this guy is getting 110, immediately we should like restricted it to 100, because for you to revert, the new carrying amount must never be higher than the original carrying amount before impairment. This new carrying amount, it should never be higher than the original carrying amount before impairment. So we always restrict it to 100 in such a way that the reversal will exactly be 30. It can be less than this 30 initial loss, yes, but it can never be higher than it. So we would restrict it. So the key is that the new carrying amount must never be higher than the original carrying amount before impairment. And that's what this third, I just need to give you this scenario to explain this third point to you. Okay. And I need to mention that goodwill, as soon as goodwill is impaired, there's no reversal for goodwill. It's never reversed. It's permanent for it. It's never reversed. And disclosures, when you have impairment loss, of course, disclosure really talks about the explanations, the breakdown you need to give to users so that they can understand how you have arrived at your figures. That's disclosure. All the figures you are deriving, all these impairment loss you are calculating, you need to explain. There are some things you need to tell the users that if you don't tell them, they will not know. And from all I've taught you, the relevant disclosure here first will be you telling us about the indicators of impairments. What are the indicators? What informed you that you should go ahead to impair? Another one is you need to tell us which recoverable amounts did you use. Because if you don't tell us, we will not know. And it's important to let users know the recoverable amount that you use. Is it value in use? Is it net realizable value? You need to tell them. And when you then tell them, if it's value in use that you used as your recoverable amount, you need to also disclose how you derived that value in use. Furthermore, if you have gotten your impairment loss from a CGU, you need to let us know. Let us know those assets in that CGU. How did you allocate impairment loss to each of them? You need to let us know. And you need to also let us know the amount of impairment loss that went to P&L and the one that went to OCI, if possible. That means if you tell us that, we will know that, okay, this was on a valued asset. We'll be able to put one and two together. That's disclosures. Disclosure requirement is not something you cram. It's something you would be able to disclose, at least for your exam. By understanding the standard, you should be able to come up with the additional information that we need to give to users to enable them understand our figures better. That is what disclosure requirement is all about. Okay, let's solve this question. Okay, I want one of you to read. Who's going
Can I
to
read, sir?
Yes, please.
As a result of privatization and the commercialization exercise currently going on in the country, the Ministry of Transport sold the assets and liabilities of the newly constructed standard gauge railway to a private company known as Stalus Rail Limited to ensure smooth operation of the railway services by freeing it from government brokerage. The summarized extract of the statement of financial position at fair value of SRL on January 1, 2019, reflecting the terms and the conditions of the sales agreement of the Transport Ministry as follows. All figures are assumed to be correct. The operating license is for a 10-year period, which was issued on 1st January 2019 by the Transport Ministry, and it is stated at cost. The carrying value of the property and the rail tracks and the coaches are based on value in use. The engines are valued at their net selling price. On February 1, 2019, one of the train engines got damaged, due to a technical fault from the manufacturer, and the engine was completely destroyed. The sale of the assets to SRL was without recourse to the Transport Ministry and the manufacturer of the engines. In view of this, it was estimated that there would be reduced passenger capacity. Therefore, the estimated value in use of the old train service business was assessed to be 1.5 billion naira. The number of the passengers after one of the engines of the train got damaged was below expectation, even allowing for the reduced capacity. In the light of this, the value in use of SRL rail service was reassessed on March 31st, 2019 at 1.350 billion. On this date, the SRL received an offer of 675 billion from another company called Papaya Railway Services Limited for the operating license. Since it is transferable, the realizable value of the other assets has not changed significantly. Required. Draft a memo addressed to the MD of Stellis Rail Service explaining the basis of allocating an impairment loss to the asset of a cash generating unit in accordance with IAS 36 on impairment loss of assets. 6 marks. B. Calculate the carrying amount of the assets of SRL Limited as at February 1, 2019 and March 1, 2019. 10 marks. Explain two conditions that must exist before an impairment loss can be reversed. 4 marks. Total 20 marks.
Okay. So, exam is getting close. You need to know this, that when you have exam questions, always start with the requirement of the question. Start by reading what the question asks you to do before you then go to reading the question. Because this A part now, I don't even need to read the question to answer it. Because they said draft a memo addressed to the MD of Stalos explaining the basis of allocating an impairment loss. I don't need to read the question for that. So, and this 6 marks, for me to get 6 marks, I really need to draft a memo. And this memo format is very important. The name of the company, memo, from accountant to MD, then the subject. Maybe on top of this form, you can put the dates or something like that. Then you can then write your, etc. Then at the end, you put your compliment with thank you, your name, your sign, something like that. That's the structure of a memo. That structure is extremely, extremely important because that gives around 2 marks or so. Then the remaining 4 marks is whatever you write as body, shall make sure you put this basis. And the basis is 1, physically damaged assets, 2, goodwill, then 3, other assets on a pro rata basis. Then if you have if you have current assets such as trade receivables, they are not exempted from allocation, but what I've told you is don't allocate to them. Don't allocate to them. unless they tell you that, okay, they have been impaired or something like that. And also, in a CGU, the carrying amount must never be reduced below its net realizable value. Yes, this one sees the higher of these three, yes. But for simplicity, don't reduce, just write it down to its net realizable value. Like I've told you already. Okay, so that's the A part. The B part is calculate the carrying amount of this company in February and in March. Okay, for 2 dates, 10 marks. So very straightforward question. So the whole idea of this question is that the government sold a railway station to this company, Stalos, and the assets of that railway station are this. So Stalos paid 2.2 billion, 2250, and we're told that in February, um, yes, one of the train engine was damaged, and because of that, they now said the estimated value in use of that old train service is now this. You see, for them to have given us the estimated value in use of the entire train station, that means they are seeing it as a CGU, and they want you to compute impairment. That means it has been impaired because of that damage. So, and from here now, since the book value of those assets was 2.25, and now their value in use is 1.5, that means there's an impairment of 750. 2.25 minus 1.5. So that 750 needs to be allocated amongst these assets here. And you already know the order. First, to be to physically damaged assets. Second, to goodwill. Then other assets on a proportionate basis. And how do you achieve that? Let me show you. So I will get as at these were the book value that they gave us in the question for each of these assets. And the impairment loss is 750, which is the total value of these assets minus the value in use of 1.5. So that's 750. First, I'm going to allocate to the damaged assets, which is the train engine. The train engine is 750, but there are two of them, and the question told us that one of them is damaged. Let me confirm. On February, one of them got damaged. So we're going to allocate impairment loss to one of them. Since there are two train engines and two is 750, that means one will be 750 divided by 2, which is 375. And that's why we have 375 here. That's why I have 375 here. Then after allocating impairment loss to damaged assets, the next one will be to goodwill. And that's why I allocated the whole of this 150 to goodwill. So out of my 750 loss, impairment loss, I have allocated to engine because it is damaged. I have allocated to goodwill because it's the next in line. So how much impairment loss will I have left? Can somebody calculate the remaining? When you take away 375, 150 from 750, what will remain? What will be the remaining impairment loss? Let's see. That means we have 225 remaining. So this 225, then we can then share it. We can share it among the other assets on a proportionate basis. And what are the other assets? License, stations, road tracks, and don't forget the remaining one train engine, because there are two train engines. So remaining one train engine. So ordinarily you should allocate among those ones. But before you do that, you need to check, did they give us these remaining assets? Did they give us any of them at their net realizable value? Because if they give us at their net realizable value, that net realizable value will become the new carrying amount, like I told you earlier. You cannot impair an asset below its net realizable value. So on checking the question, we saw that in this paragraph, they gave us some details. They told us that the license is for 10 years. They issued it in January. The ministry stated it at cost. So the license is at cost. While the property and road tracks are based on value in use, while the engine are based on net selling prices. That means these engines are the value they give us in the balance sheet is their net realizable value, which goes to show that this 750, we have impaired one of it. The remaining one also will be valued at 375. That 375 will simply become the new carrying amount of that engine because we cannot impair it below its net realizable value. So this is the first one you extend here. The new carrying amount of that one train engine, because they told us in the question that that is its net realizable value. We cannot impair below that. And since it's exactly the same thing as its book value, so no impairment loss for that. Then that means the remaining 225 is going to be shared among license, property stations, road tracks. And how do you do it? For license is simply going to be 900 divided by the addition of 900 plus 225 plus 225. If you punch your calculator, that should be around 1350. Then multiply by 225. Okay. If you do your maths for this, 900 divided by 1350 times 225, it's simply going to give you 150. The same thing for the property. 200 minus the addition of these three. That's 225 minus 1350 times that 225, which is the remaining impairment loss. It gives you 37.5. Same thing for this. 225 over 1350 times that impairment loss gives you this. And with that, you'll have allocated the impairment losses. Then you can easily get the new carrying amount as at February 1st, 2019 by saying the opening value minus impairment, in this case is 0. The operating license minus impairment, 750. The property minus impairment, 187,500. Road tracks minus impairment, 187,500. Engine minus impairment, 37,375 pounds. Of course, if you add the new carrying amount together, it's going to give you the new recoverable amount. To give you the new recoverable amount. That's as at February. The question also asks us to calculate the carrying amount as at March. So what happened in March? From here now, everything in March was here. And the only thing that happened in March was that as a result of the damage that happened in February, the value of the railway continued to reduce. So it was reassessed now to 1350. That means there is a further impairment loss from 1.5, now is 1350. So there's an additional impairment loss of 150. So in addition to that information given, they said this company that bought the railway station received an offer for 675 from another company called Papaya for the license. So another company says they want to buy the license for 675. That means indirectly they are giving us the selling price of this license to be 675. And they said that the realizable value of other assets has not changed significantly. So that's what happened in March. So with that, Let's calculate the new carrying amount now. The goodwill is gone, so these are the remaining assets left. And that means is all these assets here that we simply carried forward to this point. So the new value is 1.5. The reassessed value is 1,350, meaning the impairment loss is 150. So we need to allocate that 150. So firstly, we need to allocate to physically damaged assets, but fortunately here, we don't have any physically damaged assets. Then we need to then allocate to goodwill. Again, we don't have goodwill here. So since we don't have physically damaged assets and we don't have goodwill, then it's expected that we should allocate to other assets on a proportionate basis. But before we do that, we need to be sure that they didn't give us any assets at their net selling prices or at their net realizable value. But they gave us the license. Some people came that they want to buy it, and the license is, they say they want to buy it for 675. That 675 is the net selling price. So we simply write down this opening net realizable value. We simply write it down to 675, meaning automatically we're going to allocate 75,000 impairment loss to it, which is this 750 minus the net realizable value. So automatically we allocate 75,000 to this. And that was what I was telling you earlier, that whenever they give you the net realizable value, just use that as the new carrying amount. So whatever it is that is the difference between that new and the old carrying amount is the impairment loss. So out of 150, we have allocated 75, remaining 75. That remaining 75 ordinarily should be shared among these three. But the train engine, remember, this 375 is also at its net selling price. Okay, so since 375 is at net selling price, that means you cannot impair it further. It's simply going to become the new carrying amount. That goes to show that the remaining 75,000 will be shared between the property and road tax. And since these figures are the same and we want to share proportionately, that means we divide it by 2. So 37.5, 37.5. Then our new carrying amount becomes 750 minus 75, plus this one. 187.5 minus 37.5, 150. The same thing applies here too. And that is all. I've already told you this third one, the conditions that must exist before impairment loss can be reversed. I've told you there must be positive indicators of impairment, there must be evaluation surplus, and the new carrying amount must never be higher than the original carrying amount before impairment.